Hi, everybody. Welcome back. I am going to go through the chapter 15 practice midterm with you in this session. So I just need to get that on my desktop here. There it is. Okay. And let's go ahead and look at, there's about 15 questions there, and hopefully you've had some time to look at this, but I like to provide a video lecture of it just in case there are, particular ones that you might have some, questions about, or just like to see how I would work them. We can do that. Okay, so we're talking about stockholders' equity here, and when I look at these practice midterm questions, even just sort of working them through myself in preparation for our discussion, I notice that I make the mistake sometimes of not being careful to see exactly what part of the stockholders' equity are they asking me about. Is it the entire stockholders' equity? Is it just common stock? Is it paid in capital, etc.? And so I think you're going to see that that's going to be an important theme here as we go through. Make sure you know what a question is asking you about the stockholders' equity. Okay, so we come over and let's just look at this first one, and I'm just going to go to the call of the question here. Here they're asking me about total stockholders' equity. So I need to look at these items that are listed here and see if they constitute part of the stockholders' equity and then include them appropriately. So I look at common stock, and the common stock account, yep, that's part of stockholders' equity. I'm going to include that. Paid in capital in excess of par for the common stock. That's part of the stockholders' equity. Maybe I should back up. Stockholders' equity is going to be common stock. It's going to be paid in capital in excess of par. It's going to be preferred stock, the paid in capital in excess of par for the preferred stock. It's going to be retained earnings, right? And then we could have treasury stock, but remember, treasury stock is a subtract from the overall stockholders' equity. Okay, so I continue to look at this. We've got the common stock and it's paid in capital. We've got the preferred stock and the paid in capital in excess of par. We've got retained earnings. We know we're going to pick that up. And then we've got our treasury stock, and we are just going to study the cost method in this class for accounting for treasury stock. And so I simply do the math, adding these all up, making sure I subtract the treasury stock, and I come up with $7,800,000, the correct answer to this question. Okay? All right, so that's not too tough. Again, it's just important that going in, you know what constitutes the treasury, the stockholders' equity, and then knowing how to deal with that treasury stock, of course, is a subtract, okay, a contra equity account, if you will. All right, good. Let's take a look at this next one. Berry Corporation has $100,000 of $10 par common stock authorized. The following transactions took place during 2020, the first year of the corporation's existence. Sold 20,000 shares, issued 20,000 shares of common stock in exchange for a patent valued at $300,000, and they want to know what the total paid in capital should amount to. Now, a couple things. Number one, the fact that they give me the number of shares that are authorized here is not necessary to answer this question. An entity does not have to issue all the shares that they're authorized. We calculate the amount of paid in capital based on what was paid in for the purchase of the stock. Now, when we pay in for the purchase of the stock, of course, we could pay in cash. But if we exchange property, or we take property back, right, in exchange for the issuance of the stock, then we will leverage off the price of the stock or the price of the asset, whichever is more readily determinable. Okay, so in this case, the easy part of this question is they tell me that they issued 20,000 shares. They issued them for $13.50 per share. I do the math on that, and we come up with the 270,000. Okay, now you look, and yeah, they're trying to trick me into taking choice B with that, or I could make that mistake, I guess. But then they issued another 20,000 shares, and the patent is valued at 300,000. Now, what this question is doing to you here is they're trying to tell you, well, maybe you should use the 1350 for these next 20,000 shares, but you'd have to look, and they'd have to be saying something like the stock was trading at 1350 a share, or was listed on an exchange at 1350 a share. Then I would say that would have the more readily determined value. So for those 20,000 shares, no, we're not going to multiply it by 1350. We're simply going to pick up that they tell you that patent was valued at 300,000. That is more readily determinable, and so we would go ahead and pick up that 570,000 is what we would deal with that next 20,000 shares at 300,000, giving us the 570,000. And what did they give us? A 270 plus 270 answer? I don't think they do, right? Just looking at that from the standpoint of trying to get this problem right, 270,000 plus 270,000. If I'm on the test, on the midterm, that would be 540, which isn't even listed as a choice. So now you have no choice but to deal with that 300,000 to be able to get that answer. Okay, good. Number 3, on September 1st, Valdez Company acquired 30,000 shares, reacquired 30,000 shares of its $10 par value common stock for $15 per share. Valdez uses the cost method to account for treasury stock, the journal entry to record the reacquisition. Now, when you see a question like this, this is an easy trap to fall in, which is to try to find one side of the journal entry, since they just offer you the debit as what it is that they're looking for. Look, that's not your training. Your training is for every debit there's a credit. So I don't even look at any of the choices. I simply make the journal entry for that particular transaction that's being described, and then I look at the choices to see they're asking me for the debit, the credit, whatever. Okay, it's full. So let's go ahead. If they're reacquiring the common stock for $15 per share, and it's 30,000 shares, I know I've got to take that 30,000 times what? Under the cost method, I simply pick up whatever they're reacquiring those shares for. So 15 times 30,000 gives me 45,000, right? And then I know the journal entry, right? Because I looked at the lecture and I went through these with you. I debit treasury stock, 45,000, and I credit cash, 45,000. At this point, I haven't even looked at the answers. I'm just taking what they told me about the transaction, making the journal entry, and now I know I need to look for the debit, and the debit was to treasury stock for 450,000, John. That's why I always use a calculator. 30,000 times $15 is 450,000, not 45,000. Okay. And generally, questions don't even give you a choice that constitutes a stupid math error like that, considers a stupid math error like that I made. So you would have gone back up and looked to see that you made the wrong calculation, but use a calculator. Okay. All right, good. Number 4. Again, when they ask you for a journal entry question, they ask you for the debit, they ask you for the credit, do the whole journal entry. So this one, just looking down with this Gannon company, they're asking me for the credit. So I know I'm going to look at the transaction, see what the nature of the transaction is, and go ahead and put together the entire journal entry. So they tell me that Gannon Company acquired 20,000 shares of its own common stock at $20 per share on February 5th, 2020, and sold 10,000 of these shares at $27 per share on August 9th, 2021. The fair value of Gannon's common stock was $24 per share December 31st, 2020, and $25 per share at December 31st, 2021. The cost method is used to record treasury stock. What amount should Gannon credit to record the sale of the 10,000 shares? So you start to take a look at this one, and we have these shares that are going to be reacquired, and when you reacquire the shares, you're going to be dealing with the treasury stock and the rules for reacquiring. So this is one of those questions where I start to run out of room as I go through and try to show you how to calculate this. So let's just take a look at what happens when they go through the process. Now, when they reacquire the shares, they're going to debit the treasury stock at $20 per share. And then when they sell the shares, they're going to go ahead and they sell 10,000 shares at $27 per share. What's going to happen? Well, 10,000 times 27 is going to be a debit to cash of $270,000, right? When they resell the shares, and then they are going to take it out of treasury stock at the original price that they had reacquired it for. So they reacquired it for $20 per share, and they're reacquiring what? These 10,000 shares. So $20 times the 10,000 shares that they're reacquiring. So that's going to be this 200,000. So I'm going to take that out at treasury stock at 200,000. And then I have to sit here and I have to create an account called APIC treasury stock. And this APIC treasury stock is going to be credited for $70,000 at this point, the APIC treasury stock, because I've reacquired those shares at more than I had originally, or I've resold them at more than I had originally reacquired them for. So I reacquired them for 20, but now I'm selling them back for 27. So I'm creating an additional paid-in capital on the treasury stock. And so they say, what amount should Gannon credit in 2021 to record the sale of the 10,000 shares? Notice, guys, even though they gave me a bunch of useless information after that, they were going back to that resale or reissue the treasury stock at a later time. And so there was a credit, just looking up there, and I wrote it up there. It's a little seasick going back and forth here. I have to credit the treasury stock 2,000, credit the APIC 70,000, and of course debit the cash for the amount that came in. Okay, all right, good. So sometimes you see these questions, the way I'm going to be giving them to you, have some information that isn't particularly useful. In fact, it's a little bit harmful in that you don't necessarily want all this information to get in the way for this question. Okay, all right, good. Let's look at this number 5, and they tell us that an analysis of stockholders' equity of Han Corporation as of January 1st, 2021 is as follows. And they tell me that we have the par value of 20,000. They tell me that 100,000 shares are authorized. Only 90,000 shares have been issued. We have this paid-in capital in excess of par. We have the retained earnings. Okay. They tell me that Han uses the cost method for treasury stock during 2021, entered into the following transactions. So we acquire some treasury stock, we sell the treasury stock back at one price, and then we sell the remaining of these 2,500 shares at a different amount. Assuming no other equity, what should Han report December 31st, 2021 as additional total paid in capital? As total additional paid in capital. Now, when they ask me that, okay, I'm looking and I'm saying, well, look, I'm going to have a job here, and then I'm going to have to figure out what's going on with APIC. It could be normal APIC, but that answer would also include what? Additional paid in capital treasury stock. So I'm going to go ahead here, and I'm going to just set up APIC, and I'm going to call that APIC regular, okay, 900,000. I do that because even though they didn't issue any more stock as part of this question, I know that that's going to be part of the answer, and I want to just write that down to remind myself to pick that number up, right? Because I don't think it occurred in this question, but I could give you an answer that is just considering the APIC for the treasury stock, and then it wanted all the APIC, which would include regular APIC as well, okay? So I'm also, though, going to tee up APIC treasury stock, okay? Because I'm looking and I'm thinking, yeah, okay, that's going to have to be part of the answer here. Then I'm just going to go ahead and I'm going to follow through on these transactions. So they tell me that I acquired 2,500 shares of treasury stock for $75,000. So I'm going to start out just debit treasury stock. And I don't know that I have to do this part to answer this question, but let's just review it. I'm going to debit treasury stock. I'm going to credit cash $75,000. Do that right out. Okay. Now, more importantly with this question, I'm going to figure out what was the price per share when they reacquired. So I'm going to have to take 7,500, divide that by 2,500 shares, right? And that gives me a price of $30 per share is the original acquisition price, right? And then as I reissue those shares, I'm going to have to remember that price because that's got to come out of my treasury stock account, right? So what happens? Then they go ahead and they have these 2,000 shares at $35 per share. Well, 2,000 times $35 per share is going to give me cash of 70,000. I debit that. And then I have to take those treasury stock shares out at their original price that I required them for. So since I required them for what? $30 per share. $30 per share times 2,000 means that the treasury stock going to get credited for this $60,000, 20 times the 2,000 shares, right? Not 20 times the 2,000 shares, guys. I'm sorry. $30. Let's just write that down. $30, the original reacquisition price, right? And the acquisition price on the treasury stock times the 2,000 shares right here. $30 per share times the 2,000 shares is where I'm getting that 60,000. And then since I sold them back at more than the original reacquisition price here, that difference goes to APIC. And now it's APIC what? APIC treasury stock, TS treasury stock. TS, okay, and so that's going to be what, $10,000, right? That's the 2,000 shares times the $5 more per share. That's where the 10,000 comes from to make that journal entry balance. And then I go ahead and I post that up. I've got 10,000 in treasury stock, all right? Then what happens? Then we go ahead and we look at that last part of the transaction. The last part is they sell the remaining shares at $20. Well, that's 500 shares that are left times what? Times the $20 per share that they told me. So that's going to come out to how much cash am I going to get on that part? That's going to come out to Come on, John, you should be able to do that in your head, but you know I don't do anything in my head. That's going to come out to, well, let's just do it since I know I wrote the number down, but now I can't seem to remember where I wrote that easy calculation, and it's just hard for me to talk and think at the same time. That's going to be $10,000 cash. There it is. So I go ahead and I debit cash 10,000. I'm running out of places to write this. Debit cash 10,000, right? I credit the treasury stock at the original price. So 500 shares now times that 10,000 is going to be $35. Sorry, guys. $35, which is what I had $30, what I had originally picked it up for. Okay, $30 times the what? 500 shares, that's the remaining shares, is going to give me 15,000. Okay, so I have to credit the treasury stock there for 15,000. And then to make this journal entry balance, I have what? I need a $5,000 debit. And that $5,000 debit is going to go to APIC treasury stock. APIC treasury stock, because I'm reacquiring that treasury stock and I have to reacquire it at its original cost, and then any difference can either increase APIC treasury stock or decrease it. So here it decreased it because I did what? I resold those for less than I had acquired them for. So the balance here now is what? Balance is 5,000. And so to answer this question, since it asked me for all the APIC, I have to pick up the 900. I have to pick up the 5. That gives me the 905,000. Okay, so couple things. When you get a question like that, tee up what it is that you're going to have to analyze. Make your journal entries, post them so you can track what's going on with these accounts. We have these moving parts going back and forth with different amounts. Treasury stock transactions require that kind of an analysis to be able to, get to the right answer on the questions here. The other part is, keep in mind, it didn't happen in this question, but we're limited to that 10,000. If we were to sell the stock below a price that completely wiped out the 10,000, any remaining amount would have to go against retained earnings. But that didn't come up in this particular case. But we did have to know to take the reacquisition at a price below the original, the reissue below the original reacquisition price that had to come out of APIC treasury stock. Okay, good. So now we come through and we've got these different transactions and what is the total amount of additional paid in capital as of December 31st, 2021. So here we go again. They're going to give me some information. I'm going to have to figure out what the APIC is, and it looks like they're going to sell some treasury stock. See if I create some APIC treasury stock, whatever, and I'm going to have to go from there. Okay, so we got Percy here, and Percy does what? They issue 600,000 shares at $10 per share, and they tell us that the par value was $6 per share. Okay, so what happens? So if it's $10 per share when they issue, they would debit cash for what? 10 times 600,000 is going to be 6 million. Right. Okay, good. They'll credit the common stock at par. So it's what? It's $6 per share times 600,000. So they're going to go ahead and credit the common stock, what? 3,600,000. And then the APIC here is going to be the difference, which is what? $4 per share times the 600,000 shares. That's 2,400,000, right? Okay, So let's see if I can squeeze that in over here. So my regular APIC is 2,400,000. Now, there's no other transactions that are affected, and that are going to affect that APIC, and I would quickly glance down, and if I see any choice that has less than 2,400,000 in it, I know right away that cannot be the right answer, because my paid-in capital treasury stock can never go negative. Any amounts more that have to go would come out of retained earnings, right? Okay, but I go ahead and I'm saying, okay, I've got a 50-50 choice of getting this right? So I start to look down, and I see, well, on July 28th, they purchased 80,000 shares of treasury stock at $11. Okay, good. So if that's the case, I take the 80,000 times the 11 shares, $11 per share, that comes out to 880,000. So I know I'm going to do what? Debit treasury stock, 880,000, right? And credit cash, 880,000. Okay, so I got that done, but then they turn around and they sell the shares back in December, and they sell them at what? At $18 per share, more than the original reacquisition price. So just to make the whole journal entry, I sit there and what? $18 per share times the what? Times the 80,000 shares. $18 per share times 80,000 means I'm going to get some cash in at 1,440,000. Just doing the arithmetic on that, right? But I have to bring those treasury stock shares out at what? At their original price, right? And so I just go ahead and I'm going to credit the treasury stock. And since it was all 80,000 shares, I know that all has to come out at 880. And then what? And then the additional, what, $7 per share, or whatever it takes to make this journal question, the journal entry in this question balance, I would go ahead and credit APIC. But it's APIC now what? Treasury stock. And that comes out to 560,000. And so if I add up the entire APICs, just APIC, I guess we'll label that APIC reg and APIC treasury stock. Okay, it helps me to just tee these up to make sure I'm tracking what I'm doing. 2,400,000 plus 560 gives me 2,960,000. Now look, if they sell all the shares back, you could have taken the difference, the $7 times the 80,000 shares, and added that to the regular APIC and got to this answer quicker than having to go through and make all these journal entries the way I did. But, I think it's good practice for you to follow through everything. And remember, I'm giving you plenty of time on your exams to go through and carefully consider these questions. So I would say while you're still learning and trying to, get comfortable with this stuff, I would recommend that you be careful and not rush yourself and then end up making a mistake. Okay, good. Let's take a look at this number 7 now. And we've got this Luther Inc. And Luther did what? Has 4,000 shares of 5% $50 par value cumulative preferred stock and 100,000 shares of $1 par value common stock outstanding on December 31st, 2021 and December 31st, 2020. The board of directors declared a dividend of 8,000 in 2020. In 2021, 40,000 of dividends are declared and paid, and they want to know what is the amount of dividends that should be received by the preferred shareholders in 2021. Okay, let's go ahead and take a look at this next one, and we start getting into our dividends. And we issue dividends, remember, on the number of shares that are outstanding. That's an important thing to remember, of course, because they could be giving us the shares authorized, whatever. It could be treasury stock involved. It's always on the number of shares that are actually outstanding. And then where this question is going is when we deal with our preferred dividends. Okay, what does preferred mean? Preferred means that we're going to pay our dividends to our preferred shareholders before we pay anything to our common shareholders. And if we have cumulative preferred, which just peeking forward there, cumulative preferred means that we're going to accumulate preferred dividends if they're not paid in any one year, and then we're going to have to catch up those dividends that accumulate that are in arrears before we can pay the common shareholders. Okay, so with that quick little review here, they're telling us that we have 4,000 shares of 5% $50 par value cumulative preferred, and then they tell us the common shares, and they want to know what amount should be received by the preferred shareholders in 2021. And they start to proceed through the information that the board of directors declared and paid an $8,000 dividend in 2020, and in 2021 they paid 40,000 of dividends. Okay, so how much is going to be received by the preferred shareholders in the second year of this 2-year sequence? So what happens? Well, first off, let's just remember how to calculate these, and it's going to be the 4,000 times what? Times the $50 per share. And then we multiply that by whatever the preferred rate is here, which is 0.05%. So in any given year, they're supposed to pay what? They're supposed to pay 10,000. Now they tell me that in 2020 here, right, just putting the year next to this, they paid what? They paid 8,000. So that means that they've got 2,000 that are in arrears, okay, is what we call that, in arrears for the preferred shareholders. Now we go into 2021 now, and in 2021, again, same calculation, they're going to owe what? 10,000. But they've got to catch up what? They got to catch up that amount that was attributable to 2020, right? They've got to catch up that 2,000. So if you take the 10 from the first year, that was, a 10 that has to be paid every year, and then you add in any amounts that are in the arrears, which in this case was 2,000, that gives us the $12,000. Answer here is C. Okay? Okay, good. Now again, with these questions, they're not, conceptually that hard, but what makes them kind of hard is you have to make sure that you're clearly, making sure you know what the question asked you. With this one, an easy mistake to make would be to try to calculate the amount that is going to go to the preferred shareholders when they want to know how much is left to go to the common shareholders. So that would say, okay, once I catch up my preferred shareholders, then any amounts that would be left would go to the common shareholders, not contemplating this problem unless it was participating, in which case I would first catch up my common shareholders, and then I would distribute any remaining amounts to my, based on the relative amounts in the stockholders' equity accounts, preferred and common, to my preferred and common shareholders at that point. Okay, but in this case they didn't have participating, so it says Colson declared $230 cash dividend. Okay, now I'm going to go ahead, I'm going to write that number down, because I know that after I pay my preferred shareholders, then I'm going to have to have an amount left to go to my common shareholders. So it's $230,000. And it currently has 12,000 shares of 5% $100 par value cumulative preferred stock outstanding. It is 1 year in arrears on its preferred stock. So how much will be left, essentially it doesn't say that, to pay to the common shareholders. So if I take these, 12,000 shares of the preferred, I multiply that by the $100 per share, and then I multiply that. By the way, guys, we've had 2 questions in a row that have 5%. It doesn't have to be 5%. It could be any percentage that's associated with that preferred stock, okay? And so we end up with what? We end up with this 60,000. Well, that's 1 year worth. That happens every year for this stock. And so what happens? It's cumulative, right? And so I have to also pick up the second year, okay? So if it's 2 years, then it's going to be 60,000 for year 1, 60,000 for year 2. And so now I've got 120,000 that has to go to my preferred shareholders before I can pay anything out to my common shareholders. And so that remaining amount is 110,000 that's left to go to my common shareholders. Okay. You look at this, and they don't say anything about participating, and in this case it wouldn't matter because I have to catch up my common shareholders before my preferred shareholders can share in any amount, and I don't even have enough left over to obviously catch them up, and so I would just have to pay all that out to my common shareholders. Okay, good. Let's go over and take a look at the next question. Okay. And in this case now, the dividend that's being distributed, okay, the answer A to that last one, the dividend that's being distributed here is going to be a dividend of stock. So this company made an investment in the stock of another company, and a little while later they decide to go ahead and distribute shares of that stock of that other company as a dividend. Now there's a 2-step process to a property dividend. First, you have to calculate the gain or loss on that property as though you were selling it for cash. It really has nothing to do with the dividend at all. You have to figure out what the gain or loss on that is, and then you go ahead and you distribute the dividend, and you distribute the dividend at the fair market value of whatever that property is as you're distributing that dividend. So what happens is you have an increase in your retained earnings as a result of the gain, but a decrease in your retained earnings as a result of the dividend, okay? And so where this problem went is it said, well, look, give me the gain part of this, and then tell me the net reduction. Increase in retained earnings because of the gain, right? Gain, increase in net income. Increase in net income results in an increase in retained earnings. So give me the gain amount, and then that gain is going to increase retained earnings while the dividend is going to decrease the retained earning. Okay, so we go ahead and we take a look here, and they tell me they have these 15,000 shares of Hunter Corporation. These shares were purchased for $135,000. Okay, and then on November 15, 2021, Pearson declared a property dividend of 1 share of Hunter for every 10 shares of Pearson held by a stockholder. On that date, when the market share of Hunter was $28 per share, there were 135,000 shares of Pearson outstanding. What gain and net reduction in retained earnings would result? Okay, so I'm going to go ahead and I'm going to see that we have these 135,000, right, for the 15,000 shares. So if you look at that 135,000, and then they're telling us that there are 135,000 shares, and then they're going to distribute 1 share for every 10 shares of Pearson held, And Pearson has what? There are 135,000 of Pearson shares outstanding. Again, you only distribute a dividend on outstanding shares. So we take the 135,000 divided by what? Divided by the 10. You have to have 10 shares. So they're really going to distribute what? 13,500, not all 15,000, but 13,500 of this Hunter Corporation stock. Okay, so if I'm sitting there and I'm at 13,500, then what? They tell me that Hunter was selling for $28 per share. So I'm going to have to calculate the gain on those 13,500 shares, because you got to calculate the gain and then you distribute the dividend. Okay, so I go ahead and I take those 13,500 shares and I'm going to multiply that by what? Multiply that by whatever the gain is. Now, in this case, I'm going to write it up here. I'm selling those shares for, or on the market price. I'm not selling them. I'm going to distribute them as a dividend. But the market share is 28, and the original cost of the shares is what? And that's where I have to do some math here. The original cost of the shares was $135,000. And I divide it by what? By the 15,000 shares there. And that gives me a price of what? $9 per share that they had originally paid for those. So if you take what? The 28 minus the $9 per share, right? That means that there's a gain there of $19 per share. So I take that 13.5, I don't know why I wrote 13.5 over here. I think there's something else I want to write there. But I take that $19 per share times the what? 13.5 shares that I'm going to be distributing here. Okay. And I come up with 256,500. Okay, so look, I've got this down. I know the answer is C because I'm peeking here, but I've got this down to a 50-50 anyway at this point between C and D. But now I have to go ahead and figure out my net reduction in my retained earnings for this particular situation. Okay, so what happens? Well, first I'm going to go ahead and I'm going to tee up my retained earnings. All right, and I'm going to just make the journal entry that's going to consider this gain. So I'm going to debit my investment account. Sorry, guys. I think it's better to put the T account for retained earnings over here and go ahead and do my journal entry for my investment account over here. Right, I have a gain. So I'm going to increase that investment account, 256,000. Credit the gain, 256,000. That's going in to my retained earnings, 256,500. Right? Okay, that's going to go into my retained earnings, 256,500. Good. But now I have to decrease the retained earnings by the amount of the dividend, and I'm going to distribute the dividend at what? At the market price for that stock, okay, that I'm now distributing as a dividend. It's not my stock. This is the stock that I bought. So $28 per share times what? Times the 13.5 shares of this investment that I'm now distributing. That gives me what? 13,500 times the 28, and just make sure, I want to make sure I do my calculation right. 13.5 times 28, right? gives me 378,000. So I will go ahead now and I will debit the retained earnings, 378,000, credit the investment account. Right? So if you look at the net change in the retained earnings, I had a debit of 378. I credited it for the gain, 256,000. That gives me this 378,000 minus, I have a bad habit of losing my last three numbers, minus 256,000 gives me what? Gives me a balance of 121,500. The correct answer to this question. Okay. All right. So again, two pieces to a question like that. First, calculate the gain on, and I could just ask you what's the gain, but calculate the gain on the increase in price. It could be a loss if the price went down from the time I bought it. And then you pull out the dividend. You pull out the dividend at what? At the fair market value of that stock, and that would be the reduction in the retained earnings, and then you get that net that way. Okay. All right, good. Let's go ahead and let's take a look at this one. And here we've got this Melvin Corporation, and they want us to determine here what the amount of the property dividend, what will be the reduction of the retained earnings as a result of this. So we're first going to, again, have to figure out, well, what's the gain, and then what's the amount that comes out for the dividend. Okay, so Melvin Corporation has an investment of 20,000 shares of Wallace Company common stock, which cost $872,000. So one of the annoying parts of any one of these questions, guys, is you're going to have to sit there and take the amount that they paid, divide that by what? They bought 20,000 shares, and so 872,000 means that they paid 43, and maybe the annoying part is when I don't have enough room to write in when I want to, they paid $43.60 per share, right? $43.60 per share. Okay, good. We've got that number. Now they come in and they say these shares are using a property dividend to stockholders. The property dividend is declared on May 25th and scheduled to distribute July 31st to stockholders on June 15th. The fair value per share at May 25th, when they declare the dividend, is what? $63. And then they give me these other numbers, which I should ignore. It's what is the value at the day that you declare the dividend. Okay, so since they declared it when the price was what, 63, right, on May 25th, the dividend was declared. So I'll pick up that 63 minus what? Minus the 43.60. Okay, that's a gain of what? 1940 per share. Now I take that 1940 per share, and it's what? 20,000 shares. 1940 per share times 20,000 shares, that equals $388,000. That's the gain. That $388, okay, I'll put my T counts over here, means that the retained earnings is going to increase what? 388 for that. Right? That's an increase to my retained earnings, but then I have to pay the dividend. And when I pay the dividend, I pay it on that what? On that $63 per share. So now I go ahead and I say, well, $63 per share times, and I'm paying that $63 per share, and they did what? They said that it has an investment of 20,000 shares. These shares are used as a property dividend. So because they say these shares are used in a property dividend, then you have to go ahead and say, well, they must be then giving up all 20,000 shares. So $63 per share times 20,000 shares is going to be 1,260,000, right? And so again, they're going to debit retained earnings, 1,260,000. I'm just going to post it over here, guys. 1,260,000. And because I don't have anywhere to write it, debit the retained earnings, credit the investment, 1,260,000. You've already written those shares up to their fair value. Now you're just taking them out. So if you go ahead and net this one out, 1,260,000 minus 388 gives you 872. Now for this question, you could have just gone straight to 872. The original cost is net, what would come out of the retained earnings, but you'd have to realize that only works if you're going to be issuing all the shares they told you bought as the dividend. Okay, good. Let's go ahead and let's take a look at this next one. So Hernandez Company has 560,000 shares of $10 par value common stock outstanding. During the year, Hernandez declared a 15% dividend when the market price of the stock was $30 per share. 4 months later, Hernandez declared a 50-cent share cash dividend. As a result, dividends declared during the year, retained earnings decreased by, and I guess this is all within 1 year. I mean, they tell me 4 months later. Well, what if it was December when they gave the original stock dividend? So this is not the best written question, but we're going to assume this all happened in the same year. Now, this is a what? This is a small stock dividend. Remember, we're issuing now not investments in the other companies that we made. We're issuing our own stock to our shareholders as a dividend, and those dividends fall into two categories: small versus large. If it's a small dividend, then we're going to value that dividend at the market price of the stock. If it's a large dividend, we'll value that dividend at the par value of the stock. What's large, what's small? Well, we say that if you're in 20 to 25%, that constitutes, if you're under 20 to 25%, that constitutes what? A small dividend. And what if you're, and again, it's a range, if you're over 20 to 25 and beyond, 20 to 100%, that's a large dividend. Now, again, I'm not going to sit here and have you in that middle part. So when I give you questions, you'll know it's a small dividend because it'll be what? Obviously below the 20%. And when I give you a large dividend, it'll be obviously above that, what? 25%. I'm not going to mess around in the middle and say, well, it's a 22% dividend. Now what? I'm going to tell you, hey, it's 30%. That means it's a large dividend, right? I'm going to tell you it's 10%. That means it's going to be a small dividend. So it'll be very obvious, okay, what we're talking about. But let's just go ahead and let's take a look here. And for this particular one, it's 15%. That means it's what? Small dividend, okay? So I take this 560,000 shares, I multiply it by 15%, 0.15. Let me do that, 0.15. Rather than put the percent, right? Okay, 15%. That means that I'm going to issue what? 84,000 shares, and I'm going to issue those at what? I'm going to issue those at the market price of the stock, which was $30 per share, okay, for that, because it's a small dividend. I use the market price. So I go ahead, I multiply that times 84,000 times $30, and I get $2,520,000. Okay. Now what happens? I'm going to debit my retained earnings for that full amount, $2,520,000, and you didn't need this part for the answer, but I just want to review the journal entry. You credit common stock CS distributable for and it's at the par. So since it's $10 par, that's a 10, gives me this 840,000. That's going to the common stock distributable. And the rest is seen as a pick to make that journal entry balance is 1,680,000, I guess. Okay, now this wasn't necessary for the question, but I do need to get that debit to retained earnings because that's going to be part of the amount that's going to come out of the retained earnings. So forgive me, I'm going to make the credit side kind of small because I'm not going to be doing any credits here to retained earnings. 2,520,000, right? We got that. Now, what made this question a little more interesting is then they said that they issued that dividend. But at this point, how many shares do I have outstanding? Well, I have the what? I have the 560 where the problem started. Why did I put an 8 there? I don't know. 560,000, right? I have those where the problem started, but now I do have what? An additional 84,000 shares outstanding. So if I take that 560 plus the 84,000, someday I'm going to write all my numbers down as I get them. It's kind of hard because you put the number on the calculator and then you put in the next number and you forget to write the first number down. Meanwhile, to show you what I'm doing, I want to show you everything. So 560 plus 84,000 gets me what? 644,000? Somehow that number doesn't sound right. 560,000 plus what? Plus 84,000. Yeah, 644,000. And then they tell me that it was what? 50-cent dividend per share. So I take that 644 times 0.5, that gives me 322,000. I would debit the retained earnings, credit the, in this case, it's going to be a cash dividend for the 322. And so the total amount that came out of retained earnings as a result of this problem is going to be what? Answer A, 2 million. And I didn't, for some reason, the question, when I copied the question and didn't bring the answer with it, I didn't have it labeled down here, but it's 2,842,000. Okay, that's for the two pieces of the dividend. One, the small stock dividend came out the market price, and then when we issue the cash dividend 4 months later, you have to remember to include the additional number of shares that are outstanding at that point because of the stock dividend. That was the trick in that question. Okay, good. Let's take a look here now at number 12. And we've got a situation here where the stock was selling for $65 per share. And then they give us what is in the capital stock, and the par value is $50 per share, and it was 60,000 shares issued. So that's $3 million. And then they want to know what would happen after we issued 100% stock dividend. Now, don't get confused. This is not a stock split. Stock split has no impact on stockholders' equity at all, right? You simply double the number of shares outstanding, but you cut in half the par value. That's not what this was. This was 100% stock dividend. So this is clearly what? This is clearly a large stock dividend. And when it's a large stock dividend, we do what? We issue that dividend at par. So if the par was 3 million and we're issuing a what? We're issuing a 100% stock dividend, then we're just going to simply issue another $60,000 shares at what? At $50 per share. So the resulting capital stock account is what? Is choice C, $6 million. Notice there we ignored the market price of the stock because that was not relevant for a large stock dividend. Okay. All right, good. Let's go ahead and let's turn our attention to the next question here, number 13. And we've got this stockholders' equity section. And again, part of the problem here sometimes is make sure you know what I'm asking you for, right? You think I'm asking you for the common stock. You think I'm asking you for just the entire common stock. You think I'm asking you a pick. Here, I'm asking you, well, how will these transactions affect the balance and retained earnings, or these information? Okay, so the first thing you do is, well, since they're asking me to deal with retained earnings, I know I got to start with $85,000 of retained earnings, right? And then they tell you that there was a loss. I'm just going to pick that number up of $15,000. So since there's a loss of $15,000, I know out of the gate I've got to subtract that $15,000. Now I look and I say, please let any of the numbers be more than $85,000. I can eliminate them. No, they're all under $85,000. So now I'm going to have to go ahead and do this stock dividend part. Now it's a 15% stock dividend, so it's a small stock dividend. And they tell me, and they help me out, I guess, here. They tell me that they issued an additional 1,500 shares. That's right, 10,000 times what? Times 15, times 15 would give me an additional 15% would give me an additional 1,500 shares. So I take that 10,000 plus the additional, they told me 1,500 shares. I'll just go with the energy of what they told me. So that means I've got 11,500 shares that are going to be outstanding. And they tell me that the fair value of the stock was what? Was $6. Well, since the fair value of the stock is $6, I have to use that because this is a small stock dividend. So I take that what? I take that additional shares. I'm not sure why I calculated the 11.5 there, guys. Okay. I take those additional shares, which are what? $6. They issued an additional 1,500 shares. And so I think my mind was half in the previous problem because here I'm just going to figure out the dividend part of it. 6 times 1,500 gives me 9,000. Okay, I don't need this number, so I apologize for kind of confusing that. I don't need that. I would need the 10,000 if they told me it was 15% and they didn't tell me 1,500 shares. I would then take, and I think that's why I had written 10,000. If they didn't tell me, that it was 1,500, I'd take the 10,000 times 0.15, and that would have given me the 1,500. And I'd written that down in my notes and thought that was relevant to the answer. It is not. It's just the additional shares is the dividend, right? And that $6, use the market value because it's a small stock dividend. 1,500 shares times 9,000 means that I would also have to subtract 9,000 from the retained earnings for this small stock dividend. Do the math on that. That comes to the 61,000. Okay. Okay, good. Again, part of the trick is making sure you're knowing what it is that they're asking you in a particular question. Okay. Okay, good. Last couple of questions here dealing with some analysis of stockholders' equity, rate of return on common stockholders' equity. Okay, so we would have to first pick up the net income, $97,000, But you have to subtract off any preferred dividends that would have been paid. And so you go and preferred dividends for the year ended 2021 were $15,000. It's not even paid. If it's cumulative, you have to calculate it even if it's not paid, because we want to see the amount of income that is available to the common shareholders. So we've got what, 97,000 minus 15, and then we have to divide that by the average of the common shareholders' equity, which was $1 million at the beginning of the year, 1.2 million. And you say, well, John, that's the end of last year. Well, the end of last year is the same as the beginning of the new year. And so this is the 2020 amount is the beginning. I guess I'll label it as beginning. Plus the ending. Okay, but then you divide that by 2. And sometimes students will say to me, well, why do you divide it by 2? Because I want the average, and there's 2 numbers, the beginning and the ending. Divide by 2 gives me the average. And when you do the math on that, you get what, 82,000 divided by 1,100,000. That's just the math right there on that, what I wrote there. And that gives me 7.5%. Okay. Okay, good. And then you look at this last one. Okay, we're wrapping this up here. Rate of return on common stockholders' equity. Now, you take a look and you pick up, and they're asking me for 2021. So you pick up the income for 2021, which is $35,500. This is the numerator. And then you subtract off what? You subtract off the preferred dividends, okay? And you subtract off the preferred dividends for this year, okay? You don't worry about amounts that might be in arrears or what, because it is simply what? It is simply what is going against the current year's income here. So I sit here and I say, well, 350,000 is my what? Preferred times what? Times the 0.05. I don't have to do the multiplication of shares times the par value because it just gave me the total dollar amount. So 350,000 times 0.5, just to make sure I did my math right, 350,000 times 0.5, putting 0.05, gives me 17,500 is my preferred dividend here, 17,500, right? Okay. Now when I pick up that 17,500, right, 350,000 minus 17,500 gives me this 332,500 is the numerator here in this particular, not 32, that wouldn't that be nice? 35,500 minus 17,500 is 18,000. Okay, that's the numerator. Now, for the denominator, what happens is you have to sit here and consider, the average of the entire stockholders' equity. So that gets a little bit trickier in that you're going to have to sit here and pick up your common stock and pick up what? Your retained earnings in these calculations. So now you'd have to take what for, we'll just put 2020 first. Okay, that's not a number, guys, that's a year. For 2020, we're going to have to do 60,000 plus what? Plus 75,000, right? And then we would have to add that to the 2021 amounts for those two, right? The common stock and the retained earnings, which for 2021 is going to be 75,000 and 90,000. And then, of course, you have to take, I'll put a big bracket around all this, and then you have to divide all of that by 2. You do the math inside. Then you go ahead and you divide all of that by 2, so you get the average. And so that comes out to 150,000, okay? And when you do the math on that, that comes out to 12%, which is choice B here. Okay, all right, so hopefully that was somewhat helpful for you to go through those questions. And we're all beyond to another week here. We've got chapter 16 coming up, and then I think we're going to start to take a look for our next midterm. Okay, all right, guys, keep up the good work, and I will see you soon.